Hi everyone to Peak Market Watch. Yesterday we had another raise by the Fed of the Fed fund rate by a quarter point, and we just wanted to discuss that a little bit of where we are going from here. I'm here with my colleague John Martinez. Hi John, how's it
Hey,
going?
Anton. Cold, but finally through some of this ice today.
Yes, right. So we are in both in Dallas, and we have had a number of days of ice storms, and it's finally warming up. So that's all great. Uh, as I mentioned, the Fed has raised the rate again yesterday by a quarter point. I would say that's not really a surprise. Everyone was expecting that. But why don't we look at also their statement, and then maybe going through a couple of uh, the statements that Chairman Powell made during the press conference to provide a little bit of more elements to what was actually said, and what we can expect going forward from here, and also what the market thinks where we are going, which I think is quite interesting. Uh, so let's have a look at what uh, the official statement was, right? So it mentioned inflation has eased somewhat, which I think we all can agree that certainly has happened. The question is in what segment, and later on, uh, Powell then also mentioned that it was primarily in the goods sector where we have had a significant deflation, which then had a positive impact on the overall inflation. But the statement still is, but remains elevated, right? Uh, Touching on Russia's war against Ukraine has contributed to elevated global uncertainty, meaning also the inflationary pressure has certainly not subsided when it comes to that aspect. So they're still highly attentive to inflation risks. Uh, and as already in December, they've highlighted again that they seek to achieve maximum employment with an inflation at the rate of 2% over longer run, right? And obviously, uh, that longer run is important. That's the target over a longer period of time. Even though we are still pretty far off of that, but they want to do whatever they can to get it down to that level. Uh, and as a result, they have raised the target rate by another quarter point. And what I think is also really important in their statement, and as well as what Powell then mentioned multiple times during his press conference, even though everyone now feels that they're dovish, it's clearly mentioned multiple times. Ongoing increases in the target range will be appropriate, right? And we will continue reducing the holding of treasury securities and agency debt and agency mortgage-backed securities. So they also want to shrink the balance sheet, which obviously is an equivalent of tightening on that side, in addition uh, to the uh, interest rate increase, which also is the tightening on the interest rate side, right? Uh, Now, I think,
Anton, sorry, just
yeah,
just a quick
go
pause
ahead.
there because maybe not everyone is you know grabs the follows the logic, but when the Fed is reducing its balance sheet, effectively it's selling those securities, correct?
Yes, that's right. Right.
And
So
and then
there have been obviously buying securities, which provides liquidity to the market. Once you sell it, it has the opposite effect. Right?
yeah, and so then we'd have that upward pressure on rates as well, correct?
Potentially, yes,
Cool.
which
Okay.
generally is happening, right? When there are less market participants that are willing to buy, it doesn't matter what it is, whether it's securities, whether it's cars, whether it's homes. Uh, as soon as you have a reduced amount of buyers, generally it has an impact on prices, right? And when it comes to the credit market, if there are less investors in a particular security, like a bond, the spreads tend to go up along those lines because the remaining investors obviously have more of a power to dictate where the credit spreads ultimately should be.
Gotcha. Great. Thank you.
Yeah. So when we listened then to his press conference, and the Wall Street Journal always publishes the transcript. I think the Fed itself is also publishing a transcript if you want to look that up. Now, what is again right out of the gate, right? His statement is still strongly committed to bring inflation back down to 2% target, and we have more work to do, right? So clearly, the message from in the formal statement as well as in his prepared speech before the press allowed being asked to ask questions was very clear. We are going to raise rates more later this year. And again, anticipate that ongoing increases will be appropriate, right? So now what is interesting when we look at the markets, clearly they read into a dovish element by Powell as well as the overall statement, because they also mentioned disinflation a number of times. But when you look at this here, at his statements, that, in my view, is just not dovish at all. And again, why the inflation has come down, but we are still well above that 2% target that they have. Now, also he mentioned again the slowdown of the growth, which definitely has happened. The labor market remains extremely tight, right? And again, right, we obviously have goods inflation, but we also have wages that have an impact on inflation, and we have overall services that have then an impact on inflation. And as wages go up, service sector inflation also has an upward pressure. And he mentioned inflation remains well above their target. So nothing really new there. Now, we continue to anticipate that ongoing increases in the target range for the federal funds that will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2%. So now, just within 2 minutes of his speech, he mentioned that multiple times. So for me, it's really interesting how the market then still picks up some of the other statements that he has made and feels that it's really more of a dovish stance that they have taken this time around. And obviously, he talks about shifting to slower pace will better allow the committee to assess the economic progress toward our goals, right? But reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. So in my view, he points out, look, we will have a slowdown across the board in our economy. We will have an increase in unemployment, and that ultimately will have a positive impact on inflation. And obviously, if you want to read that into a dovish comment, that's definitely possible. But it's also important, right? So obviously, market is always focusing on what is happening today and every hour, every minute. And he mentioned our focus is not on short-term moves, right? It is our judgment that we have not yet a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate, right? So anything that he has been saying here in his formal statement, and then in the first question that he took, indicates that he has a dovish stance, or that the committee has a dovish stance there. And he also then highlights, right, in the housing services sector, we expect inflation to continue moving up for a while, but then to come down, assuming that the new leases continue to be lower, right? And for all of us who are in the multifamily space and residential investment space, that is certainly what we already have seen, I think, in a lot of markets where leases have flattened out, and in some markets even have weakened a little bit. So I would say here that is definitely an element where he might be slightly behind the curve, where he still feels that there is an increase in leases, when in reality we already have reached the peak, and some markets already have retracted from the peak. Naturally, this is a perfect statement for the market to say, well, he is dovish. Right? Right? Do you agree, John?
Well, I agree, but I think going back to your comment just above about looking at his comments about the need, almost saying that there's a need to see weakness in the labor market. And I can't remember if it's later in the statement or if it already passed, but he comments about how their willingness to fight the basically the cementing of inflationary expectations. So it's as if that he's signaling that there needs to be tangible, measurable, quantitative pain, so to speak, in order for there to be confidence that the medicine has been taken and that the patient is having the improvement as expected. So, I see where people would maybe see that as a positive, but the language, I guess, doesn't really seem to have changed. It seems as if here's what we've prescribed. We're going to keep giving it to the patient, even if maybe in potentially smaller doses, but we don't see the material change that we're expecting. So
yes, yeah. Mm-hmm. And again, right, so in the same sentence, he highlights again core non-housing services. They haven't seen really any disinflation yet, right? And so then also there was a question, well, so in December they talked about a level where they will top out with the Fed rate. Is it 5%? Is it 5.25%? And his statement is, look, that's where we were in December. They have not really looked at it this time around. They will look at it again in March, right? And so he also leaves it open, right? So it could certainly be higher than we were writing down right now, right? And again, he refers to that 5 to 5.25 that they have set in December. And then if we come to a view that we need to write down, to move rates up beyond of what was said in December, we certainly would do that. That's definitely hawkish, right? And at the same time, if the data comes in at the other direction, then, as you know, we'll make that data-dependent decision on cutting coming meetings, of course, meaning it could be that they bring that level down. It might be then at slightly below 5%, right? Who knows? But I just do not read into this as any type of a dovish statement whatsoever by Powell. Now, naturally, he mentioned our assessment is that we are not very far from that level. We do not know that, though, right? And I think when you listen to his press conference and his answers, this is really one of the key elements that he continuously touched on. It's the uncertainty. He mentioned uncertainty multiple times. He mentioned we do not really know. And just reading into that they are dovish just because they are uncertain and do not know in what direction we are going, I think is really a little bit premature there, right? Now, he also touched on the debt ceiling. He clearly states that raising the debt ceiling is an absolute crucial piece. It's not really a surprise that that is a statement and a position by the Fed, so nothing new there. And let's see here, right? So now he also is talking about the personal consumption expenditure index, right? Which right now is quite low, but he also feels that that is a transitory, so it will move up again, and that they feel that it goes up again relatively quickly above to the 4% mark. And I think that's an important element there. Whenever we talk about inflation, you always have these spikes. Then once, which was roughly a year ago, then naturally, once you hit that year anniversary, inflation year over year naturally comes down because you already had that spike a year ago. But I think he is also clearly seeing that the inflation there likely will go up again. We do not know. He doesn't know, but that's at least the anticipation that he has there, right? So now let's see what one of the questions was: can we get there with just 5%, right? And that is probably a little bit of that dovish element that everyone is now highlighting. And he says absolutely it's possible, right? So which means that we potentially have just 2 times 1/8 of an increase, maybe a quarter, maybe 1/8 afterward, who knows? But that's certainly from his point of view, that's where he believes we can end up and we can fight inflation. I think that is definitely his view, his world view, and probably the majority of the Fed committee. The question is how quickly they are pivoting back down from that point, right? And the point, one of the questions was, look, obviously we have come down on the CPI inflation from more than 9% to 6.5%. Is now the hard part coming to get down from 6.5% to 2%? And here again, the uncertainty element comes into play in his answer again. I don't think we know, honestly, right? And that's really, I think, truly an honest response, because no one knows. He doesn't know, and it's important why he is so uncertain compared to maybe other positions he has had in the past or others may have had in the past. And this statement here is really, in my view, the core to that, right? This is not a standard business cycle where you can look at the last 10 times there was a global pandemic, because there wasn't, and we shut the economy down and Congress did what it did and we did. It's unique. And that's reality what it is, right? We have upset the global economy in such a way with the pandemic and the global response to it, that, as he says, I think certainty is just not appropriate here. And that is really the most honest answer that he potentially can give, right? Now, generally, it's forecast of slower growth, some softening in the labor market condition, and inflation moving down steadily, but not quickly, right? In that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year. Now, here again, he clearly makes a point that as long as the economy is performing as what he believes and the Fed committee believes it's going to perform, which means slower growth, some softening in the labor market, and inflation moving down steadily but not quickly, then they are not going to cut the Fed rate this year, right?
Yeah.
So I think that's a pretty clear statement there, but somehow the market doesn't believe that, right? Or the majority of market participants still do not believe that he is really holding to that statement, or they have a strong belief that inflation comes down much further, the economic activity slows down much faster, i.e., we do not have just a slow growth, but we potentially have a negative growth. But then again, the question is, why is the stock market booming if you really have that belief, right?
Yeah.
There is definitely a disconnect there, uh, and right. So the reality is, over and over, he is highlighting the fact that he just doesn't know, right? And I think that's ultimately what he has communicated. However, when it comes to the market, uh, they clearly have a different view there, right? So naturally, when we look at SOFR as the Fed rate, it has jumped up significantly, right? So we are at roughly four. Average is 4.3. The one month term is at roughly 4.5, even above that. Uh, Prime rate, which is also certainly when it comes to banks and credit unions, is a crucial borrowing index. We are at 7.5%, so extremely high compared to where we were just roughly a year ago at 3.25. Uh, and obviously, the 10-year Treasury has moved up as we know, but in comparison, and when we particularly look at the yield curve uh, uh, of the 10-year and 2-year Treasury, now we have that inversion, which has been very significant. It started to invert last July, and it has essentially been inverted all along, and now we are almost at as close to where we were at the peak in December of last year of around 85 basis points of an inversion, which is it's extremely large inversion there. So clearly, the market has a different world view here. We do not know where we are ultimately. Now, what's your take there, John? How do you see it, and how do you see as an investor, particularly as a borrower, right? You need to make a decision whether you want to go short term with your borrowings, you want to go medium to long term with your debt. If you're in
Yeah.
that situation here, what would you do?
Yeah, I think we talk with investors, and you and I discuss this as well. If you're looking at a deal, you've got to be very realistic about what is a broker telling you, sales broker telling you, as far as what they're hearing is available for debt, and where is capital available? Is it going to be very likely a bridge loan, and how will that cost you, and how long can you wear that? And making some reasonable assumptions of what permanent debt will look like in 12 or 18 months. And that's a hard call, but the deal has to pencil out for you. If you're looking at a refi in that next 12-month window, or maybe even 18 months, you have to kind of maybe think about whether or not it makes sense to go longer rate, even if you think that in the short term, shorter term rates might come back in the next year. So so I think for some of the refi, it's a function of your liquidity window. Do you have the time to wear it out a little bit? But it's a little bit challenging. Hopefully most of these deals, folks are looking well in advance of the windows for either a maturity, or as their prepayment penalties start to come down, to get a feel for what the appropriate amount of, rather, term of debt would be, and at what rates might be out there. Because I think that it's difficult and to believe that we could have any more certainty the Fed has. And I think you just highlighted that going through these statements, there remains a significant amount of uncertainty. Not only just what the Fed's looking at, but then how we interpret that, as far as whether or not we're going to see the changes that would allow the Fed to become more dovish. And then there's execution risk on the back end of, if there is a change and you're in the middle of trying to close your deal, what is your execution risk as well. So hopefully folks are thinking these things through, talking with good advisors that can give them a good roadmap, advising them of the risks that are out there, so to speak, in their deal, either acquisition or refi, and able to advocate for their deal in the event that there are problems. Because I think that's kind of, this is an environment where we kind of earn our keep, so to speak, where you're fixing those problems as they occur because you're leaning on that experience.
Yeah, definitely. So my take on this is, right, obviously we do not know where the short-term rates are going to be. Even if you believe as a prospective borrower that the short-term rates will come down significantly over the next year or 2 years, what I would say is that more likely than not, if there is a significant reduction on the Fed rate, we are in serious trouble, meaning the economy has slowed down significantly. We will likely be in a significant recession. And when you look at the index that you may have as a starting point for your short-term borrowing, that might look great. However, if we have a serious recession and downturn, as a borrower, you also need to recognize that the credit spreads can be significantly higher. So your overall borrowing cost, even though the Fed rate may have come down, the prime rate may have come down, and SOFR for the ones that are borrowing on the SOFR-based short-term loan, they may all have come down significantly, but this credit spread may have gone up significantly because the market generally is much less liquid. A lot of market participants, i.e. lenders, have moved out of the market. They have paused their lending activity, you name it. And ultimately, that means that your borrowing cost might be higher despite the Fed rate and SOFR being lower in a year from now, right? And on top of that, in some instances, you may not even be able to get the financing that you thought that you would be able to get, just because the market is in distress for a period of time, because we are in a significant recessionary environment. So what I'm saying, and I've been saying this all along, be careful of what you're wishing for, because if anyone believes that the rates will come down significantly, the credit environment is likely not going to be very pleasant for borrowers, right? If it's just coming down a little bit, then it's fine, right? But when we talk about significant drop in borrowing in Fed rate over the next year or so, it definitely will have it will be the result of an economic environment that will be highly unpleasant for everyone.
So, Anton, for folks that are listening that have different experiences, or in following capital markets, and be maybe even thinking about credit spreads, in your experience, when you see credit spreads widen, do you see that as blanket widening across asset classes? Are there any geographic considerations when we think about the different types of products an investor that is borrowing or needing to refi might think about? Because presumably for a lot of folks, an environment where credit spreads quickly widen would be new to them. What are a couple of things you can maybe share with folks as to think about that risk. Hopefully we don't get to that point, but if we do see a harder downturn, what might folks want to think about how that's going to impact, the deal that they're looking at in front of them or the deal that they're having to refi.
Yeah, so I would say the credit spreads will certainly vary from asset class to asset class, as it always has been, right? Uh, but the spreads will move up in a difficult economic environment with perceived, at least perceived, increased credit risk by lenders and investors in these loans across the board. So even though multifamily historically, as an example, has a much lower credit spread than hospitality properties, hotels, if the spread for hotels, let's say, goes up by 2%, it might still go up by 1 to 1.5% for multifamily. So overall, spreads tend to go up among all asset classes. And when we look back to 2008, 9, and 10, even in the multifamily space, credit spreads increased significantly, right? Even though the Fed rate came down and overall treasury yields came down during that period, because again, there was no lending that was taking place outside of the lenders of last resort in the multifamily space. As we know, it was Fannie and Freddie that were the primary players there. But if you had a loan that you needed as a bridge loan, construction loan, you name it, you have had, everyone had a very hard time to refinance or get a new loan during that time outside of the agencies, even for an asset class like multifamily. So this is just a warning. We obviously do not know in what direction we are going, but it's always important to recognize that the Fed rate and SOFR are not necessarily what ultimately is impacting your borrowing cost. The credit spread is absolutely crucial, and the liquidity in the credit markets is absolutely crucial. Right?
Great points.
Yeah. All right. Do you have any other points you want to make before we get off for today?
No, that's it. Thanks for getting me on here with you to look at this, and we'll see what happens the next go round.
Yeah, definitely. So, guys, whoever is listening, watching, leave your comments. Let us know what your view is. Right. So we do not have that a better crystal ball than any of you. We just have to make all educated guesses, and we might be right, we might be wrong. So it's always interesting to hear what everyone else is thinking and what their strategies are. So thanks again for joining us today, and see you soon again.